Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Joining us here is Taleb and Scott Patterson in celebration of a brutal book. I really can't say enough about this. For Global Wall Street, I'm sorry, this is the adult book, Chaos Kings. William Cohen, he wrote a book about Duke lacrosse. It was brutal.
That, yes.
Bill Cohen just says, Scott Patterson, he's done it again, which he did in 2012 and with dark pools and all that. And the problem we got here, David, is we can spend the next 3 hours with Taleb, but we got to give some love here to Scott Patterson, who's only here because James Madison University beat Chapel Hill this week.
Bring it up again.
That happened.
Yeah, that was a black swan.
Your book, in full disclosure, I'm totally in Massim's camp, and Massim knows that, like wicked in his camp. So, when you set up your book, which is the Taleb team, like JMU, against the other team, some French dude like UNC. How did you set up that polarity? Describe the tension of Chaos Kings.
Yeah, well, Nassim's belief is that you can't predict markets, so you just need to prepare for extreme events all the time, the black swans. And I contrast that with another character, a French econophysicist named Didier Sornet, who uses advanced physics and other mathematical models to try to predict these big events. He calls them Dragon Kings. Which
technical term.
Yeah.
Yeah, I call it Newtonian envy. So he's a math guy, right?
Yeah, he's a math guy. He uses some things that could be used to predict the explosion of rockets and transpose that onto financial markets.
You got to be kidding me. Here's the reality, folks. Nassim Taleb changed the world with John and Nero in Fooled by Randomness. Everybody else would have retired to Turks and Caicos or whatever. He went on to do Black Swan, and then you and I sat on the stairs of St. Bart's on Park Avenue, and you described Anti-Fragile to me. Nassim, where is the humility among the quants in this great bull market?
The point is, you don't need humility. Humility actually is not necessary. I don't mind people are arrogant. There's just got to be paranoid about the right things, namely how much an error costs you when it happens, that ruin problem. And basically, Scott's book is about ruin problems. So you could be arrogant about everything, all right? You could be wrong all the time. Doesn't matter.
Like pandemics.
Just you got to avoid ruin. The big things. You got to be right about the big sources of risk, and the rest take care of itself.
Could I get your, having come out of the pandemic, your perspective on what happened there, largely, but within markets as well, the reaction to it, what we saw?
You mean the pandemic?
The reaction to it, yeah. Okay.
We were. I mean, Scott discusses what happened in the pandemic. And how we were obsessing over it. I mean, when we started the idea of Universa, when Mark started Universa, I was a passenger. I was a retired passenger, but the name Universa means universal properties, and we're talking about some universality of these classes of tail processes that generate large tail events. And I call them gray swans. Hence, that's where the name Universa came from. So, I was obsessing even when I wrote the Black Swan about pandemics, and kept obsessing. And I say, okay, I didn't remember the interview, but someone asked me, what do you have to worry about? This and that. And this. I said, no, you got to worry. First thing about some germ traveling on Air France. Because Air France, you get good food, and if they're bad germs, they travel on British Air, or they get bad food. So that was my obsession. And sure enough, nothing had happened since for 100 years or for close to 100 years, right? So, and then people say, well, just like financial risk, people's perception for risk before the crisis say, oh, we don't have to worry about these. They don't happen anymore.
Right.
Sure enough. All right,
Scott Patterson, you've got, one of the sections is the Boston section, the wicked problem. And the answer is flying blind. I mean, you've been doing this for 15 years at the Wall Street Journal, trying to figure out the mathiness and the certitude, and I'm going to wake up and win. We're number 6, we're going to be number 2 or number 1. What are we flying blind on right now?
I think that, right now there's obviously a huge amount of complacency in financial markets.
Yeah.
We're hitting records time after time, and yet you look outside Wall Street, and it looks pretty crazy. So there's all sorts of things that could happen, and I know Massim wants to talk about China. I've been predicting China would collapse for 2 decades now, and they don't.
Right. Be careful. Cash flow lives there, my oldest son. Be careful. Okay. China's not going to collapse. Let's do this. We'll do China, David Gura in the next section. Okay, we got an extended conversation with Nassim Taleb and Scott Patterson. Chaos Kings is a book. Okay, I asked that question to Scott and Nassim to set you up here. We're flying blind. Nassim Taleb on private equity and private credit. It's all the rage.
The first thing I have to say is that we have a debt problem in the West. Okay, whether individual or government, you can have debt. China has debt, but you must grow. And the problem of the West is that we have an S curve of growth or of GDP or per capita, and it looks like we're on the top right of that curve. So it's concave, and people have 2 cars, they have 2 homes. What do they want? I mean, have Perrier water shipped to them? I mean, so the incentive to grow isn't there. So here, it's a serious problem when you have low growth and a lot of debt. And the problem is that Western, economies have never had more debt in history.
How do our listeners...
At a time where growth became concave simply because of the nature of growth. You grow fast when you're China because you got pulled people out of the provinces and stuff. Right. And standards of living can still rise and make a difference.
Now, see, they're not quants at Credit Suisse years ago. They're our listeners, our viewers, they put their pants on one leg at a time. How do they hedge against your concave tensions that we're in right now? How do mere mortals hedge this?
Okay, the whole thing is, it's not a hedge. If you're investing without a tail hedge, you're practically not investing because of the ruin problem, and that's what he discusses in the book. That's my first statement. And the second one is that people are way too static. They imagine either they have a memory that's either too short or has problems updating, that they don't realize that, for example, what's happening in China is that the Nature Index of publications, that's very hard to gain. What China used to have 1%. Today it's in the 20s and rising. So it tells you that that's a leading indicator of what technologies may come out of China. So you realize that you got to look back to before 1750, around when the Industrial Revolution started. So we're starting to shift, and in 1830, China had 8 times the GDP of Britain. We're back there. Soon it's gonna. So we're going back now in time. It's like reversing the dominance of the West, not because the West is doing poorly, but because it got what it wants.
David, we're going to China right now. Nassim's running the show. We're doing China here right now. We'll do the stock market opening here in 4 minutes. David Gura on China with Scott Patterson and Nassim Taleb.
Scott, let me ask you more about, you said you've been predicting the sort of dissolution we've been seeing for 20 years. What stands out to you about this moment? We've spent the whole week talking about these kind of unprecedented actions, the way they were delivered by the PBOC in China, and what that says about the actual state of the economy there. Talk a bit about that and sort of your vantage of it, and also just sort of how much veracity we can ascribe to the statistics that we're getting out of China.
Well, as to the veracity of the statistics, who knows?
Who knows?
They keep doing this. They hit a slowdown, and then they, hit the accelerator. They've pulled, after the GFC, the Great Financial Crisis, China pulled the entire world out of that situation by stimulus. Who knows how long they can keep it up? It's a big mystery. Right. For me, my focus these days is on climate, and the dominance of China in climate technology is astonishing. And that's the future of energy. It's the future of vehicles. Right. It's the future of batteries. And they're, light years ahead of everybody. We're trying to catch up. Yeah. Europe's trying to catch up. And that for China is a big advantage.
I got to do a shout out here. The Wall Street Journal this week with a stunning effort. China's newest nuclear submarine sank, setting back its military modernization. That was an incredible story out of your shop. Now, see, on China again, continue. It's, Aaron Friedberg for Foreign Affairs says it's a Marxist-Leninist regime. Okay, Nobody in Beijing read Fooled by Randomness.
No, but the point is that China is the reverse of Europe. If you're small in China, you can do whatever you want. If you're big, the government calls you up for a meeting, all right? So in Europe, if you're small, you're overregulated. You got like 5 tax inspectors breathing down your neck. You got to get all these permits. If you're big, then you own the government, okay? It's particularly the case in France, Germany, practically everywhere in Europe. So China is a reverse. So they say, okay, it's capitalism, okay, for the small, and communism for the large. And it's effectively, it's not that much. There's a centralized economy except for the top.
So what about America into our fractured election, our fractured nation?
Okay, I don't know about whether the election makes a difference in many respects, but we have a problem, and that problem is that our debt servicing is increasing. And I guess, did we cross, is it more than military spending? Is it more already? Okay, so, and it will continue and pay interest on that. Now you may say interest rates may be lower. I don't think we can go back to zero interest rate, because zero interest rates got us here, all right? So we're going to go back to normal interest rates. So the debt problem is not going to go away. Debt servicing is going to keep increasing. And the problem is, if the East becomes, and not just China, just the East in general, becomes powerful and becomes a target of, retirement money and stuff like that, then the dollar would be in trouble.
Michael Mauboussin with us 2 days ago, and Nassim Taleb today with Scott Patterson in celebration of Chaos King. Scott, what's the other side of the story here? The mathiness and certitude of Zurich, Switzerland.
You're referring to Didier Sornet, the Dragon Kings guy. We were talking about China, predicting what happens in China. I just, after covering financial markets and talking to hedge fund managers who 20 years ago were billionaires and now they're, bussing tables at diners. This is where I come down on Nassim's side, is I don't think you can predict markets. I think it's impossible. I think that when you look at quant trading strategies, they're very short term, like over the course of a few minutes and seconds. Those are the only strategies that really survive long term, and even they, my first book, The Quants, showed how they almost blew up in the 2000s in a period of big deleveraging.
They're basically getting a higher dimensional bid and ask. Okay.
Yeah, they're trading bid and ask very rapidly, and that's good strategy. But trading, making big bets on your prediction of what China is going to do next quarter, next year, or what the Fed is going to do.
I think we've seen this.
Is very, very hard to do.
My humility here, David Gura, is it's a once-in-a-lifetime event. And, years ago, in the old world, which is where Taleb is from, Lebanon and all that, and over to the continent of Europe, they're laughing at us about once-in-a-lifetime event. You and I have gotten gray. Wait, Gura doesn't have any gray hair. But the answer is there's a lot of once-in-a-lifetime events. David?
I have a question about young people in this industry, and it's inspired by a conversation I had with my friend Robert Smith, who is at NPR. He's now running the Night Badge program at Columbia. I said I was going to be talking to you today, and he said, here's what you should ask him. And he pulled up a tweet that you filed more than a year ago now. The story we haven't covered this week is Caroline Ellison of FTX getting sentenced, going to spend 2 years in prison. And you tweeted about Sam Bankman-Fried when everything blew up. You said, the problem with people like SBF is knowing a tiny bit of statistics to parrot about it, but not understanding processes, that is, dynamics across time. Shakespeare has survived nearly half a millennium by filtering by time. Then you close. Sam Bankman-Fried worked at Jane Street. You write, to Jane Street, he would have flunked my job interview. What does the Nassim Taleb job interview look like? What do you ask somebody who's applying for a job?
People understand some basic things like ruin problems and understand dynamics. So, which is the same, that people, if you have tiny probability of losing money, you eventually will go out of business, okay? Because over time. So if you're aware of it, that's fine. If you're not aware of it, you got a problem. The other one is sizing. Comes from sizing also. If you have the edge, you still have probability of 100% of blown up if you don't size properly. So sizing is very delicate. Two basic things. And the third one is about fat tails, the difference between tin tails and fat tails. And that's pretty much the theme of the black swan, the remedy in anti-fragile, and discussion of why people don't understand it and skin in the game.
Okay.
So the difference between fat tail and thin tail, finance is not Gaussian. Mm-hmm. Now, everybody claims, we know that. Yeah, if you know that, then why are you using Gaussian tools? What tools do you use? What do you suggest? People in the street understand the Pareto 80-20. Mm-hmm. It is very intuitive. You need to learn to know some math, but not enough, okay, to get to stuck to if you teach people a little bit of math but not enough, they go to the Gaussian.
Nassim's laughing at me here right now because he knows it's a third role. David, thank you. Gur and I don't speak before the show. In fact, we're not on speaking terms. Yeah. But I'm so glad you brought that up. Yeah. Nassim, come on, you know me on position sizing. Position sizing is everything. And right now we're living in a Mag 7 world where everybody, whether they admit it or not, as Scott Patterson's 401k at the Journal is loaded up with NVIDIA and all the rest of it. Nassim Taleb on Mag 7, the anti-position sizing.
Okay, so let me give you one thing since I don't have a lot of time. Okay.
Yeah,
I wrote a tweet saying that if someone gave you 24 hours in advance tomorrow's newspaper, that you would go bust. And actually, someone just tested it. Victor Hagani, formerly of LTCM, who visibly has long experience in the market, tested it by giving people over 15 years next day's newspaper and giving them, you can trade at today's price, knowing tomorrow's newspaper. And people didn't do well. Why? One of it is, of course, sizing. Yeah. They don't know how to size a position, right? When they're right, they don't know how right they are because they can't figure out how much of it is noise, right? And of course the sizing. So and it just I heard of the paper yesterday because it starts with my tweet. It's interesting to have a tweet turning into a paper by someone else.
Yes.
Like for someone lazy like me, it's perfect, right? Because tweets I do in airports typically, right?
So and that's not how markets work. The markets work on anticipation of news events. Oftentimes, when you see the Fed cut interest rates, the market will go down because it's already traded on that news.
There's a Fat Tony story in Anti-Fragile, all right? How people who anticipated the invasion of Iraq or the starting of the war against Saddam in 1991, those who anticipated it went bust. Because guess what happened to oil prices? They collapsed, right? So it's not figuring out the news. There's something more subtle about markets.
Okay. I want to get one more question here in Chaos Kings and Nassim, and then we've got to talk to you about a fractured, your old world, your Europe with 1, 2, 3. They're calling them conflicts, but I think they're wars. Scott Patterson, you have such a history of writing of the tension of Wall Street. In your experience, is anybody on Wall Street putting the tension and the outcome of your books into practice, or are we still wedded to VAR? which I know Massim loves VAR. Has anything changed on Wall Street?
I think that's it's funny. No, I don't think that we learn our lessons. I think people are still using value at risk, even though it it was a laughing stock in 2008. People looked at this and like, oh, this is insane. We're cutting out 5% of the worst days every year, and like that doesn't matter. So yeah, no, I don't think we learned our lesson. I wanted to come back to the question of an interview asking, at a hedge fund.
Yeah.
I spoke to a while back somebody who you know at Renaissance Technologies, and the big quant shop on Long Island. Mm-hmm. One of the questions they asked prospective employees is, how does a toilet work? Mm-hmm. Which, you're talking about dynamics. I thought that's a good question. Interesting. The answer is it's a vacuum.
I want to devote the rest of the time with great honor to all the people from Lebanon that have assisted David Gura and I in what we've seen over the last weeks, days, and indeed quarters and years, led by Jumana Bercecci over in Dubai, who has been really helpful to us here. Her show is Horizon out of Dubai. Look for that. Massim, you have lived this. You were in your family, were deputy prime ministers, you were involved with it out of the Greek Orthodox Christian sphere of a Lebanon I remember with great prosperity.
Yes.
It is shattered. What is your...
I was in Lebanon 2 weeks ago, and I go to Lebanon, I reside there part of the time. So what you see in pictures doesn't map to, and when you hear about the economy, it doesn't map to what's going on there. They've been a little slowed down by the Gaza war, some kind of rise in across all economic sectors in Lebanon on a more anti-fragile basis. In other words, the collapse of the government of Lebanon economically gave rise to decentralized municipal power and to a lot more entrepreneurship. Okay, because the central bank was conducting a Ponzi, and the Ponzi went away, and then suddenly people recovered, and 4 years later, it's on a mend, and you can see economic activity across all sectors. I mean, restaurants are all full, new restaurants opening up like every day. At least in my neighborhood, like 40, 50 past year. I mean, every day, every week. So what the perception of Lebanon from the outside is quite distorted, given that I spent time there. This war, I think, is, there is a problem. Okay, let's say there is a problem. The fighting is confined to Hezbollah and the state of Israel, but of course there are side effects outside. But something tells me that if you go to a bigger war, if Israel wants to drag the U.S. into that war, right, then thing would blow up. But
David, one final question. David, one final question.
How do you gauge the prospects of that happening? We've been
I think that the U.S. is resisting, and the Iranians are trying to be nice, and there is a more of a conciliatory tone here. So we'll see. I mean, from there you can see how irrational it would be for everyone to get involved in to broader war, particularly that long term it's not going to help. I mean, think about it. Israel had a war with Hezbollah in 2006. They got stronger. They occupied southern Lebanon, and Hezbollah been stronger and stronger. So every war is just like a delayed training program for Hezbollah. So Israel doesn't have it's in its own interest. Okay, you can't destroy a ideology. You can destroy military installations.
That's okay. I do that all the time. It's part of surveillance. Coughing on air is part of surveillance.
Tom does do that all the time.
So we got to leave it there. Nassim Taleb, thank you so much. One of the protagonists of Chaos Kings: How Wall Street Traders Make Billions in the New Age of Crisis. Scott Patterson, thank you so much for coming today. This is a really, really important book for global Wall Street. Not so much what to do, but what not to do. Scott Patterson's Chaos Kings, setting up the tension between two giants of investment. dying to talk to Lindsey Piegza of Stifel. She's really pushed against soft landing certitude. Dr. Piegza, thank you so much for joining Bloomberg Surveillance. How remote is a soft landing?
Well, I think it's still a possibility. It's still out there as a potential for the economy, but it is going to be challenging for the Fed to achieve that. Remember, part of the soft landing is instilling price stability on a sustained basis. So getting us back to 2%, not just touching it, but maintaining that, along with the prospect of avoiding a downturn. Now, I do think on the growth side, at least in hindsight, the U.S. economy remains on solid footing. But I'm not convinced that the Fed has the focus, has the stomach to get us back to 2%. They seem to be very complacent at this point with this very tepid, somewhat sideways and uneven movement in inflation at this point.
I know they would beg to differ. We have heard such adamance from the Fed chair about that 2% target, but it raises this larger question of, when do we get there? There will be no declaration of victory, of course, but what's it going to take for you to say, look, mission accomplished, pick your trope, the Fed has been able to win this fight?
Well, that's right. The Fed's forecast does not look for 2% on a sustained basis until 2026, so some 2 years from now. But in order for me to get an increased level of confidence that we will get there eventually is further meaningful progress. Now, this morning's report was encouraging when we look at the headline number, but the core, after several months of sideways movement, has now ticked higher. So we're moving in the opposite direction of that 2% price level. And you have to couple that with the lack of movement that we saw in the core PPI, the core CPI. So there's a number of key inflation metrics that are showing no further improvement, offering no further confidence to the Fed that we are on a sustainable disinflationary trend. So I do find myself in the camp of the sole dissent in December, Michelle Bowman, saying, no, there's still inflationary risks out there. There's upside risk potential, and we need to stay focused on that inflation component of the dual mandate.
Lindsey, if you and I were in the Eccles building looking at that dashboard, looking at all of these data in complement, what are the types of data that stand out the most to you as most important here as we move ahead?
Well, I think as the Fed is looking at, the key data points are the inflation data and the reads on the labor market. But what's interesting is when we look at the labor market data, independent of any commentary from the Fed or the media, the market, the labor market is still near full employment. The unemployment rate, yes, has ticked up from a low level, but we're still at 4.2%, well below what the Fed designates as that full employment range, the desirable or a sustainable level of joblessness. Jobless claims have not ticked any higher. So the other side of the the other side of the labor equation, job destruction is not seeing any upside movement. We're still talking about over 7 million job vacancies. And on average, we're still creating over 180,000 new payrolls month to month. So that's still indicative of a tight-ish labor market.
If you're joining us, Lindsey Piegza with Stifel. Thrilled that she's with us today after this report. It lifts the market. Quiescent CPI, PCE, I should say, price index. Futures up 3 now, up 9. NASDAQ up 35 points, 0.2%. Small cap leads the way up a solid 0.9%. The VIX comes in ever so slightly, 15.29. Looking at the yield space, 10-year yield 3.77 in 3 basis points. I always look at the 10-year real yield 1.60, comes in 2 basis points. Sort of inconsequential. It's now time for the math portion. We do this with Piegza of Stifel.
John and I are going to get a coffee while you do this.
Lindsey, I'm going to cut to the chase. From the cheap to the high Fed funds rate. We have a belief in 8, 9, 10 rate cuts to come to get back to the center tendency, 2.8-ish, 2.9-ish, maybe 3% as well. To me, it's wildly nonlinear. Aren't the next 25 or 50 basis point sort of a non-event, and the real sweat for the Fed comes, say, the spring of 2025?
Well, yes, in the longer term and in terms of the longer term timeline for getting us back to neutral. But I would push back and say that the next 2 meetings are going to be key in terms of setting the tone for the Fed's willingness to remain data dependent. If we see A stronger than expected labor report, coupled with this morning's somewhat disappointing move in the core PCE, I think the Fed is going to have to respond with a much smaller rate cut or a potential skip of a meeting. And if they don't, that's going to send the message to the Fed that maybe they're less data dependent than they're indicating, and they are on somewhat of a blindsided focus to get us back to a particular position in policy, regardless of what the data is saying.
Across the history of the Fed, and particularly the more modern Fed, which labor statistic really matters? Is it non-farm payrolls? Is it the unemployment rate? Is it something David Gura and Tom Keene don't understand?
I think the Fed's going to look at a number of factors, but if we had to look at one, it's going to be the unemployment rate. It's going to be that fluctuation into or still away from the full employment range. Now, the non-farm payroll number certainly seems to set the tone for market expectations, but when it comes to monetary policy, Fed officials typically focus on that unemployment number to really gauge what the momentum is in terms of labor market conditions.
What you heard there, folks, really, really important. David, I want to stick you in. Folks, again, we're commercial-free for across this hour on the PCE statistics. The market lifts on it as well. We thank all of our good sponsors for allowing us to do this. David Gura, Anna Wong at Bloomberg Economics, and she pushes against Dr. Piegza. There's no question about that. She's got non-farm payrolls, 3-month moving average, 116. She does a revision, which is hugely controversial, and lowers that number. And that's a polarity between Wong and Piegza.
Lindsey, let's marry these hard data with the softer ones. We had Dana Peterson on the show a little earlier in the week and talked about those consumer sentiment numbers that were softer than a lot of folks expected, and I think spooked some folks in the market as well. How do you look at them in complement? And you were talking about what would happen if we saw a real sharp decline in employment, for instance, how the Fed would react. How would both investors and consumers react to that as well? Because that has to be front of mind for Fed policymakers too. Yes, they're kind of looking at this in a very, in this vacuum of looking at it from a policy perspective, but they have to be aware or cognizant of how people are going to react to what they're doing as well.
Absolutely. And we have to also be aware that not all the data is going to point in the same direction. This is not going to be an easy decision for the Fed or an easy interpretation for the market by any means. But when we look at some of this secondary and tertiary data, what we're continuing to see is an ongoing resilient consumer. Now, as we saw this morning, somewhat softer income and consumption numbers, but looking at the Q2 GDP report, we anticipated that. We knew what the third month was going to be. But when we look at that on average, we're still talking about a 3% growth rate and a 3% spending rate. That's still very indicative of a solid economy and an economy that can withstand a very slow and patient removal of policy firming. So I go back to the Fed's decision in September. The biggest risk of a 50 basis point move was always sending an inappropriate signal of concern regarding the state of the U.S. economy, the current level of weakness, as well as an inappropriate signal that the Fed is willing to rush back to a state of not just neutral, but accommodation to provide stimulus to an ailing economy, as opposed to simply removing their foot from the brake and moving back towards neutral as the data begin to normalize.
Lindsey, one final question here, and this is immense respect, and part of the Piegza charm, folks, is she's out in the Midwest. She's putting up with Cubs, White Sox, and all that. Lindsey, seriously, the Fed has to aggregate towards one policy. Can they not do that because the American labor economy and the personal income around this polarized economy is so split? Can they not succeed at aggregating?
Well, it is difficult. When we talk about the resilience of the consumer, it is dangerous to paint with a broad brush because we do see that those at the middle and the lower end of the spectrum are having a much more difficult time faring in this environment amid higher borrowing costs, higher prices, the resumption of student debt payments. Meanwhile, those at the top are not necessarily feeling a pinch amid a growth of household net worth over $16 trillion in the past year. So we do see two very different themes in the underlying consumer. And it's not a difference of haves and have-nots, but asset holders and non-asset holders. So that is complicating Fed policy, but that's nothing new. We always see that bifurcation. But what we do see, which is new, is this growing divide among Fed officials themselves, While the median is looking for 50 basis points by the end of the year, 9 Fed officials say, no, we're going to see maybe 125 basis points cut or no further adjustments.
This is great.
So that divide alone, I think, underscores how difficult the December decision was and how difficult further decisions are going to be.
David, if Piegza was a governor, she'd dissent at every meeting. She'd be the Catherine Mann of American economics.
No more unanimity.
She'd be like pounding the table. Jay, no, don't do it. Lindsey Piegza, thank you so much. It's Stifel there pushing against the soft landing. Joining us now from Chicago, where she's interviewing to be the general manager of Chicago White Sox, Gina Martin-Adams. Gina Martin-Adams joins us here on your stock market, your bull market forward. Gina, I'm going to cut to the chase. There's all this noise, China this, China that, Are we just discounting still double-digit earnings growth?
I think it's a great point. Is the macro has oftentimes overwhelmed the earnings in terms of commentary, but ultimately earnings drive stock prices, and earnings have frankly continued to surprise the consensus. Right now, the analyst consensus is looking at close to 10% earnings growth emerging over the course of the next year. I would say the stock market is pricing closer to 5 to 7% earnings growth, just based upon what our macro models suggest. What's been so interesting about the last 2 years, and I think this persists, is the macro has been closer to what the market prices, where the analyst consensus, even though they've been conservative, are still not bullish enough. And so that big divergence is what has created the uptrend in stocks. Is we persistently have this sort of negative undertone, this negative view that is embedded in the psychology, that's embedded in prices, but kind of the reality on the ground from corporations is that things are still improving and have been improving really since 2022. And that doesn't appear to be changing. Analysts are slowly getting on board with that. So certainly they're, expecting better growth in the next 12 months than they did 12 months ago. But it is a slow sort of climb.
Textbook Gina Martin-Adams, and she combines this, like Ed Hyman, with fundamental analysis, technical analysis, and a respect for the economic. Gina Martin-Adams, what does the bull market chart tell you?
Oh, well, I mean, look, the trend is your friend. The stocks are still,
to the late Marty Zweig,
up and to the right? So very simplistically, when you're making new highs, and more than 70% of stocks are still trading above their 200-day moving average. So contrary to popular belief, breadth is still improving. We're making new highs. Even small caps are showing some signs of clawing their way out of their bear market condition that has existed for the better part of 3 years. There's just not a lot in the charts to complain about. If there is anything to complain about, it is really about leadership inside the market, where we do appear to be sort of grappling with a potential leadership change away from the Mag 7 toward the 493, other stocks in the S&P 500, sort of away from predominantly growth towards some more value-oriented industries. There are a lot of internal churning happening, but nonetheless, markets are still making new highs, especially the S&P 500. So there's not a lot to complain about from a technical perspective. The only thing that I would say from a broad charting perspective that we're watching with a really close sort of eye is what's happening with momentum. When we look at what's happening with momentum in the S&P 500, it's been struggling as a result of this internal churn. It certainly has confirmed the recent rally off of those October sort of depressed lows, but nonetheless, it's not as positive or not as strong as we would like it to see, or like to see it. And I think that that's something to watch going forward. We do need to gather a bit more momentum to sustain the gains that we've had.
Gina, great to talk to you. And I wanted to ask you about this China story that we've been following over the course of the week and what it means for U.S. investors. We talked a little earlier in the show about the PBOC put on Chinese equities. What does it mean for the palatability or attractiveness of Chinese stocks, what the bank has done this week?
Yeah. I think it's been tough in China. Honestly, we've had, a series of stimulus measures all year, from direct purchases of assets in the market to changes in policy rates to the news of this week. To the degree that it ultimately creates some more stability in economic conditions, That's the thing that I think can draw investors back into China. It's a wait-and-see approach, though, with respect to China. And it's been such a difficult run for the last several years as a global investor starting to think about investment in China that we've had a proliferation of EM equity products excluding China, just to try to get at where the other growth opportunities are in EM. So, I would say we need to see this manifest itself in real economic conditions and, even more importantly, real earnings growth prospects improving for China. That's a long time coming yet, because when you look at EM equity revisions ex-China, they are surging. Equity analysts are getting much more optimistic about the outlook for earnings growth outside of China, and analysts are not telling us that things are getting better in China yet. So we need to see that momentum turn around there.
I got to ask you this, Gina. I know you're not on speaking terms with Allison Williams, but the banks for end of Q3, what is their business plan for Q4? How bad are the cost cuts going to be?
Yeah, I think, first of all, I'm on great terms with Allison Williams, and I think she's a brilliant analyst in terms of...
All those HR courses help Gina.
In terms of financials, I think that it's going to be really interesting coming into this quarter because the banks spent so much of their time really cutting costs back in 2023 that's been a bit of a tailwind, right? Remember, 2023 was the year in which we saw tremendous provisions, a lot of concern about loan losses emerging in commercial real estate, decent amount of cost cutting coming out of that sector because the yield curve was tremendously inverted, right? We've come off of that deep inversion in the yield curve over the course of the last several months. That improves the outlook for net interest margin for some of the segments. But it's still tough going. What was most interesting out of the second quarter is that financials, for the first time in a long time, beat on top line. We saw better revenue growth out of financials than we've seen in a very, very long time. That's what I'm looking for going into third quarter, because that's what's been missing in financials for the better part of 5 years, not just sort of short-term what's happening with a lot of cost cuts. When we get into October, and then even more importantly in the January season, though, I think you do want to start looking for layoffs. Are we going to see a surge in layoffs again? This sector has been a big, persistent part of that story from 2022 on. Financials, as well as technology companies, communication companies to a slightly lesser degree, have led the layoff trend. They've kept costs very, very lean, and that's enabling margins to continue to stay afloat there. So there are a lot of moving parts to watch for in financials. It's frankly one of the sectors that we've been watching most closely in this rotation because we are seeing much better growth start to emerge there, and finally some investor interest. But I think that's mostly related to the yield curve so far.
Gina, don't take the White Sox job unless you can clean out the bullpen. Gina Martin-Adams from Chicago, where she's on a job interview at Comiskey Park, which I will always call it.
I'm going to fact check this entire interview.
Grandpa took me to Comiskey Park. I saw Nellie Fox a few years ago. Only Michael Barr on the planet knows who Nellie Fox is. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.